His Morningstar 5-star rated First Eagle Global Fund is up about 4% this year, outperforming the S&P 500. Joining me now is Matt McLennan. He's co-head of First Eagle's Global Value Team. And we also have Tom Simons, who's the chief U.S. economist at Jefferies, here to discuss that stronger than expected retail sales data and, of course, what to expect from the Fed chair in the next 5 to 10 minutes. Lots to get to. Let's start, Matt, might as well off the back of that gold picture, because not only have you had great performance this year, you've had, I think, gold as your top holding. Is it now time to trim it, given this run, or are you kind of very committed to it for the long term?
Well, we've been long-term holders of gold, and the reason we own it is as a potential hedge against the unknown, and particularly if you think of the passage of the last few years, Russia invading the Ukraine, the fiscal blowout under the prior administration, the recent tariff issues, the whole host of issues that have been going on have brought a spotlight to sovereign risk. And gold has been a source of ballast against that, and obviously helpful for our portfolios. What I will say, though, is that we are primarily investors in business, and so we own gold in combination with business. We don't want just to have a directional view on gold. And so in periods of supernormal strength, it's not unusual for us to trim a little gold and recycle that into the ownership of businesses that are available on sale. And that's really how we think about it from a long-term standpoint.
Tom, give me just a very brief snapshot of what you are really looking out for from the Fed chair today.
Yeah, no, I think that we saw a preview of this basically with Governor Waller's comments earlier this week, which is a differentiation between tariff-led price level increases and inflation. You know, inflation is always and everywhere a monetary phenomenon, and to quote Milton Friedman, right? You can't have the false equivalence of saying the tariffs are essentially a tax increase on consumers and also expecting that they're not going to then respond the way they do to tax increases, which is to reduce consumption because real income is lower. So I think it'll be a more dovish standpoint that he's going to be coming from, you know, probably talk about the potential that there could be rate cuts if things start to unravel.